Welcome in Richard Clarida, the former Fed Vice Chair, Global Economic Advisor at PIMCO. All right, Rich, what's your take? Welcome.
Well, I think there was a lot of focus on would the dots remain unchanged, and so they still show the two cuts, albeit with a little bit more disagreement. I would point out the downshift on the growth projection is basically to the pace of growth the Fed thinks is consistent with trend or potential growth. But yes, they are emphasizing the uncertainty, and I'd expect the chair to say that in a couple of minutes at the press conference. And then finally, I think there was some speculation based on the January minutes that they might end QT entirely today. So essentially, they're saying they're going to cut back the pace of the runoff, but still do some runoff. So all in, I think a pretty constructive meeting compared to some of the concerns going in.
Market seems to be most happy that despite their upward revision to their core inflation forecast, they upped it by 0.3 because of tariffs. But they didn't change the fact that they still could do two cuts, right? So you're kind of getting that best possible. They're looking past the tariff impact there.
I think you're 100% right. There's been an ongoing debate in the press, online, and I'm sure probably at the Fed about the best way to think about the Trump tariffs. And consistently, what Chris Waller and Chair Powell and others have said, the first instance is to look through that as not inflationary. And I think today's signal from the dots is an indication that that's their baseline. They're going to be attuned and attentive to inflation. And if you look, they indicate that there is upside risk to inflation from this forecast. So I think that also explains some of the change in the language wording.
There's a firm out by a big mall called Fashion Island in Newport Beach, California. They manage trillions of dollars. They're called PIMCO. You might have heard about them, Richard. And PIMCO's job is not to react to the Fed as much as it is to anticipate what the Fed, or what more importantly, the bond markets may do. The bond market, as I pointed out at the top of the show, may be saying something different than our friends at the Federal Reserve are, because borrowing costs have actually gone up, not down, even as they're talking about cutting interest rates. Where does PIMCO see borrowing costs 6 months and 1 year from now?
We had a big move up in Treasury yields, in the anticipation of the election, and then after the election, the so-called Trump trade. So some of the move in yields really has not been so much about monetary policy as about, the fiscal outlook. We've consistently said we think we're going to be in a world of a steeper yield curve. I noted that on your conversation a moment ago. The 10-year Treasury yield has really been in a range of between 375 and 475, and that makes sense to us right now. The big question is, when and how rapidly will the Fed cut, and that's going to be very data dependent. So I hate to disappoint you.
But Rich, my point was, does it listen, I'm not discounting the Fed. They run the show. Yeah. I get it, okay? They're kind of like the referees, if you want to compare them to March Madness. But they're talking about cuts, and the bond market is going in the opposite direction. We have viewers and listeners that are thinking about buying a home, and they're waiting for rates to come down, and they hear, ooh, the Fed's going to cut, honey. Don't worry, we'll wait a couple of months, and mortgage rates will come down. Guess what? They've waited, and mortgage rates have gone up, not down, since the September 18th Fed rate cut, where they sort of bizarrely sliced by 0.5% and talked about inflation being somewhat elevated. That was in September, not now. How much do you trust this Fed, Richard?
Well, I trust the Fed. What I acknowledge, though, and is that a lot of things drive Treasury and mortgage yields and mortgage rates. If you look at the pricing and interest rate futures towards the front end of the curve, they do price in those two rate cuts. But a lot of factors. Secretary Bessent himself says, I want 10-year yields to be lower, and that's going to depend on fiscal policy as well. So I think that's the way that I think about it.